So we're talking about the interest rates, inflation, and how they affect the exchange rate. And yesterday we talked about um, on Monday we talked about the Fisher effect, where we talk about the nominal interest rate minus the expected inflation that actually gives you the real yield. So today we're talking about the interest rates per se, and I want to actually show you a couple of things. First of all, on Monday, we looked at this inflation rate year on year for that comes from Bureau of Labor Statistics for the US. And notice how at the current level, it is at approximately 3.72%. And this is an annualized inflation that is based on the CPI. So, and I want to actually show you how, if you look at, say, one of the largest banks in the US, the Chase, and if you look at the CDs for 1 year, let's see if these are actually offering a profitable return. So the zip code for our school is 70118, and if you look at the rates, right? So again, we are looking at 1 year. Up to all the amounts, actually. Notice how they're at 3.5%, which means that from now, if you were to open or buy a CD, a certificate of deposit with Chase, which is one of the largest banks in the US, for our zip code, you would earn, regardless of the amount, you would earn a nominal interest rate of 3.5%. Now, considering that the inflation is right now 3.72%, that actually leaves you with a loss of 0.22%. So again, this is interesting in the sense that the CD is actually offering less of a nominal interest rate given the current inflation rate. The rate is actually higher for 6 months, which simply probably assumes that the inflation will continue at this high rate for the next 6 months, but probably will come down after that 6 months and into the year. So these rates kind of show that. However, with respect to the Fisher effect that we talked about, the nominal interest rate being the pronounced, what's been announced at 3.5% for a CD, and minus the inflation, that's 3.72%, it kind of leaves you with a 0.22% of a loss. So at this point, the real yield is actually negative. So what are some of the indicators? Like how can we check what interest rates are for the US, for the US dollar? So, I mean, often you see me pulling up this US Treasury yields by the Department of Treasury. These are auctions held and sold through Fed, and you can actually see different years and say for this year, for the current month, notice how we have 1 year expectation, 1 year yield of 5.12%. I'm sorry, 5.49%. So these kind of make a little bit more sense than the CDs that we just looked at. With a 1 year US Treasury that you buy, your yield, your net earnings will be 5.49% as of the auctions on 2nd of October. And if you look at it now, for today, it is 5.42%. Now we're talking about a positive real interest in the sense that if the inflation is 3.72, and if the 1 year bond yield, treasury yield is 5.42, then there is an actual earning of 1.7%. And that's your real earnings, real net yield. The increase in your purchasing power will be 1.7%. So there are other obvious, the interest rates that we can look in the market. Like for instance, I usually look at the ETFs, Um, so, I mean, obviously, when you look at the U.S. Treasuries, these are the highest credit quality, especially up to 3 months. We consider these to be risk-free with respect to default, liquidity, and interest rate risk, or more like, I guess nowadays, more like up to a month. But regardless, these are considered to be um, the more conservative investing in fixed income, uh, you know, securities. So on the other part of the spectrum, you can look at an ETF called JNK, which simply I think stands for junk, and you can actually look at the holdings for this, and this will actually show you the current interest rate for these low credit rating holdings. Notice how in this, oh, it doesn't show the holdings. So notice how the yield on this is actually a little bit higher than the US Treasuries. And the current yield, this actually pays the periodic, this ETF pays the periodic dividend, which simply makes up or made from the coupons that are paid out um, from the bonds that are included in this ETF. And this actually pays a 6.66% yield for this ETF. So this is obviously higher than any one of these maturities. And this is the risk premium that one would expect holding what would refer to as junk bonds. Um, so the interest rate, we talked about how the nominal rate minus the inflation, and then you have your net yield. In this respect, we are actually looking at, with respect to the U.S. Treasuries, you're looking at the prime um, borrowing by the Treasury. So you're looking possibly the lowest rates that anyone can borrow in the market. Um, and that's the US government. And this is relatively riskier on the other side of the spectrum. And this is the yield for these types of low credit quality bonds. Now, there are a couple more at HYG, so high yield corporate bonds. And I believe this is also very similar to the JNK, where your yield is 5.82%. Let's see if we can find the holdings on this one. Yeah, no, not so much. So there are a little bit better ones. I mean, if you look at, say, the total bond market, which includes mostly the treasuries, and notice how the yield is actually 3.04%. But this is the total bond market that includes, or supposed to include, the corporate bonds and treasuries. But I think that for this one, for recently, they have been a little bit more on the treasury side. There are obviously short-term ETFs. This is 1 to 3 year US Treasuries. Notice how the yield is significantly lower, 2.6%. And one wonders, if I'm going to be investing 1 to 3 years, why would I actually go for 2.6% when I can simply buy a, say, 2 year bond right here for that actually pays about 5%. So nowadays, these yields are really low with respect to these ETFs. And let's look at one more, and that's the TNT. TLT. So TLT is the 20 plus years, so longer maturity. And notice again, the ETF's yield is 3.52. And if you're looking at 20 plus years, we are actually supposed to be earning anything more than 5%, whereas with this ETF, we're earning about 3.57%. So the issue with this interest rate differential between the ETFs and the actual bonds is that these are newly issued bonds, which simply means that as of today, these bonds are issued and people like you and I are buying these, and currently that's what we're paying for these. However, the ETFs, now these are the ETFs that have been holding the bonds that they have purchased in the past. So what happened since the Fed started to, increase the interest rates is that the price for these bonds have gone down. And because of that, the price of these assets also have gone down. So let's take a look. So for instance, we looked at the JNK, and if you look at, say, to the 5 year, um, so if you look at this monthly chart on the JNK, notice how, especially after 2020, the price of this have gone from $110 down to 90, and it's actually 89 today. So, when you buy a US Treasury for the first time, you are at the most opportune moment because you are, these assets are priced given the market conditions of today, whereas the ETFs already include bonds that were purchased, some time ago, and therefore the prices have changed. And given the Fed has been increasing interest rates, the prices actually has gone down. So this is one of the risks that we discussed in class about the bonds. You're primarily looking at the interest rate risk. When the interest rates rise, the price of these bonds, the bonds that you own, goes down. And therefore, when you buy a bond, you actually have that risk of losing the price of the bond, the current price of the bond. However, you should understand that as long as you actually keep the bond until the maturity, you will end up having your face value and nothing actually changes it. So I guess one thing that now that it is time to discuss, there is an ETF. Well, not just an ETF, but Treasury a few decades ago came with what's called Treasury inflation protected Treasury tips. So they actually, I'm just want to talk about this for a few minutes, but Treasury actually came up with what's called the Treasury inflation protected securities. And their intent is to provide investors with a yield, a positive yield, and plus protect them from any changes in the inflation. So how do these work? These actually work a little bit different than in an ordinary bond. So with an ordinary bond, you actually have um, a current price. This is the price that you agree to pay, and then you have a face, and then or the face value, and then obviously whatever difference that you pay is your net earnings or net yield. So if your face value is $1,000, and if you actually end up paying for this, say 800, then your net earnings will be $200. It's very simple. So every bond actually works very similarly. So with a treasury inflation protected securities, the way that it works is it works pretty much the same like a normal bond, except treasury changes the face value, which actually does not change in any other bond. But with the TIPS or the treasury inflation protected securities, they actually change the face value based on the inflation. So if the inflation is say 1%, then the face value goes to 1,010. If the inflation is 10%, then the price actually goes to $1,100. What you pay for it today or when you purchase it does not change. Obviously, that's how much you pay. However, the face value is adjusted based on the inflation. Now, again, there's a cap. The cap is this actually is usually very beneficial for those who buy this for the first time. So very similar to these US treasuries, when you buy them for the first time, you're actually buying the market conditions and you are literally paying for these as of today, given all the alternative investment opportunities, all the interest rate levels, all the inflation levels that are available to you, and then you agree to pay and earn this much yield. However, after you purchase them, you see, the idea is, let's say that you actually purchased it in the secondary market. Now, this specific bond has a face value that's adjusted to be $1,100. However, if the inflation turns out lower, just like here, when you looked at um, the inflation actually has gone down from, say, 9% all the way down to 3, which means that at one point, this face value was 1,009. Now, let's say that you actually bought this in the secondary market and the inflation has gone down to 3%. What will happen is the Fed will actually adjust this down to 1,030, which means you could end up actually losing $60 on it. So after you buy a Treasury inflation protected bond in the secondary market, the face value of the bond can actually change against you. I think the only guarantee you have is that the face value would not fall below 1,000. Although again, you should check on that. Things change every day, and anything above and beyond that, you're on your own. Which means that when you buy these bonds in the secondary market, there's no guarantee that the face value will not go down. So, having said all of that, let's take a look at how the interest rates and the inflation actually work. So, so how the inflation and interest rate actually interact with each other. So remember, our objective is to look at how inflation, interest rate affect the exchange rates. So, at this point, we discussed about the inflation, now we're discussing the interest rates, and I just want to see how inflation and interest rate are affecting each other. Remember, there is no direct tie, meaning while we want to increase the interest rates as a central bank to deal with inflation, well, obviously, it's not it's not as easy and as direct as people think it is. Meaning, the Fed can be increasing interest rates all they want. If the inflation is rising, it may need to be interest rates may need to be increased even further. So while the Fed is trying to tame the inflation, the interest rate may not be directly correlated with the inflation rate, which means the inflation rate and the interest rates are not actually tied in a direct relationship. And it's not mechanical, it's not robotical, which means that the economy will work however it actually operates, and the interest rates will be trying to either speed it up or slow it down. However, there's always some lag that when the Fed actually looks at the market information, there is never a simultaneous check on the market, and therefore Fed always tries to play catch up. And this catch up is the lag, is the missing link in that direct relationship between the interest rates and the inflation. So this is the inflation that we've been talking about. So let's add to this, say, the 20-year, 2-year government bonds, right? So the orange is um, the yield on the, and let's look at just one. And there's obviously no earlier than 1 month. The frequency has to be at least a month. So the orange is the 2-year yields and the blue is the inflation. Now notice there's an obvious negative correlation. However, so if I were to draw, say this is where this is going, and then you can see how this is going. But notice how if this is your origin, right? If this is your origin, the slope for the interest rate is a lot wider compared to the slope for the inflation is a lot wider compared to the slope for the interest rate, which means that the relationship between the two is not 1-to-1, And in fact, at one point, if you look at, say, this point where the interest rate actually has gone up, um, the, significantly, the inflation only tamed just a little bit. So, the countries, the central banks do try to tame the market with, um, increasing the interest rates and therefore trying to lower the inflation. However, that increase in interest rates, its effect sometimes may not be sufficient. And notice, like the first few months of this year, the the interest rate actually was even lower, right? So, and at that time, the inflation was also coming down just based on the intention of the Fed. So this affects the international outlook. And unfortunately, when the money travels from one country to the other, as we talked with the crawfish tray example, the interest rates are comparable, the inflation are comparable, but the numbers that you're looking at are all historic, and you are placing your investments, placing your investments based on your expectations. So, looking back historically is 2020 hindsight. When you're looking at this, unfortunately, all you can see is that the interest rate increase have been working. Although for the past couple of months, it doesn't look like it's working. But now, when you make an investment decision to invest in a country, the expectation is that you are hoping that this relationship will continue and that the interest rate minus the inflation net yield will be still positive, and you will actually end up earning a positive yield. And I want to emphasize this. When you make that investment, one of the things that you do not know is obviously the inflation. When you make an investment, you know your nominal interest rate. You just don't know what your actual inflation will turn out to be. And therefore, at the end of your investment horizon, and only then, you will know how much you actually earn. So you are, in a way, placing a bet based on the expectation of interest rates and inflation. So I also want to talk about how within this scheme of inflation and interest rates, how does the financial markets play? And we discussed this just a little bit at the beginning of the semester, where you actually have um, a spectrum of investments, and the bonds and the stocks and the real estate and savings and cash all have their place within this spectrum. So if you look at, say, the market, and this is again 2 years return, 2 year yield on a 2 year bond. And if you look at the, say, S&P 500 for the past year or past couple of years, you'll find a, and I think that it will be best if we compare this to the 2 year. So notice how the blue is the S&P 500, and then the orange is the 2 year treasuries. So, and this is a going all the way back to 2019, and we actually start right at this 0 point. And notice from that 0 point, the S&P 500 went up about 60% compared to where it was 3 years ago, 4 years ago. And look at the US Treasuries and how they actually lost so much value during the COVID, and how their current yields have gone up and exceeded even the S&P 500 level. So in a way, when we make investment decisions internationally, you are looking at alternative investment vehicles, securities, and just as you can invest in bonds, you can also invest in stocks. And stocks are actually priced very similarly, in that people are expecting a yield out of these stocks given the current market conditions, given the other investment vehicles. So, in this respect, all yields will be, your investment at today, and then your payout in the future minus the expected inflation. Or if you're at in the future, you travel into the future and you look back, how much you had a payout today, how much you actually ended up paying a year before, and what the inflation turned out to be, and what's your net yield. So regardless of the security type, whether it's a bond or a stock, you are still exposed to this risk of unexpected changes in inflation, purchasing power, and obviously unexpected changes in the market's reaction to, as things change, the prices change to market risk or the interest rate risk. And it seems to be quite universal across different assets. And we have seen this so vividly since the COVID, and especially after the Fed decided to change their monetary policy from dovish to hawkish. So let's take a look at some comparable interest rates, and then we'll look at comparable inflation. This kind of puts perspective into our crawfish tray example. We basically, if you are an international investor and you're looking to, find the best allocation for your portfolio, which countries actually provide you with the highest return, nominal return, and then, which countries have relatively higher risk, and which countries have the relatively higher inflation. And remember, while the interest rates may be nominal, the inflation is all expected, and the risk again are all expected. So just a very simple comparison where you have Japan with a negative interest rate, Switzerland 1.75%. These are all current rates. China at 3.45, Singapore at 3.77, and notice how United States is 5.5, United Kingdom is 5.25, Canada is 5, Euro area is 4.5. And as we go down in the list, we actually have countries like India at 6.5, South Africa 8.25, Mexico 11.25, Brazil 12.75, Russia 13%, Turkey 30%, and Argentina 133%. Again, these are all looking so good. Like, I want to invest in these countries that pay double-digit or triple-digit interest rates, but notice that you're actually taking a country risk, and therefore, there's always the market risk, liquidity risk, and the default risk. And Argentina in the past have filed for bankruptcy a few times and defaulted on. No, I'm sorry. Argentina actually did not file bankruptcy. They actually defaulted on some bonds, and so they are at a high risk. But the other countries, like Russia, for instance, there's always this risk of this military intervention in Ukraine, and therefore, how their economy is going to turn out is at risk, or if they're going to continue to be integrated into the international financial community is at risk. And therefore, in our crawfish example, you're looking at how these countries, compare to each other with respect to risk and return. And I think the only variable we're missing is the level of inflation. So let's take a look at that. So, these are the interest rates that we had, and now we're looking at the inflation rates for these countries. And notice China has 0, Netherlands has 0.2, whereas United States 3.7. And as we go down, to our double-digit or triple-digit countries, Australia has 6, Russia has 6, United Kingdom has 6.7. Turkey has 61.53%, and Argentina has 138%. So in that respect, with an interest rate of 133 and an inflation of 138, you are actually losing money by investing in Argentina. So the expectation then must be that the inflation would cool down in Argentina, and therefore your 133% will make sense. With respect to Turkey, the yield is 30%, your inflation is 61%, and you're basically losing about 30% by choosing to invest. And again, that means the expectation is that the inflation will cool down below 30% and you're going to make money. However, these are all expected. And therefore, the nominal interest rate is what it is, minus your expected inflation. And then you actually have the real rate, and you will only know it after your investment horizon or after your investment maturity. And so the idea now is that on Friday, we'll actually tie in the inflation discussion and then the interest rate discussion into how they affect the foreign exchange rates. And it's actually a very opportune time simply because of the COVID and after COVID, post-COVID Fed monetary policy change, how the exchange rate of US dollar changed against all others. And then we'll look at how, for instance, for the Brexit, how risk affected British pound, and then with Ukraine and Russia, how risk affected, the Russian rubles, and then now that we have this issue in the Middle East, how it's affecting the Middle Eastern currencies, the U.S. dollar, the European currencies, and not only the interest rate and inflation, but also we're going to introduce the risk component into the exchange rates. So again, thank you for working with me, and please let me know if you have any questions. And thank you so much. So bye for now.